This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion.
I won't waste much time with introductions. Let me get right into the heart of the matter. August 2020. A little best of today. I know I've done a bunch of best ofs this summer of COVID, but damn, some of this stuff is so great. And if you add them together, you get something even more special. My three guests today, Harold DeBoer, Howard Marks, and Jeffrey Gitomer. Who are these three guys? Harold is a trend-following trader with TransTrend. Been around for a long time. Took me a long time to get him on this show. Great insights. My second guest, Howard Marks, happens to be a billionaire. Would you like to know how he made those billions? Tune in. He gives some insights, at least from the philosophical perspective. And my last guest today, Jeffrey Gitomer, one of my favorites, author of the Little Red Book of Selling. Man, if you didn't see this thing in the last 15 years, where were you looking? The Little Red Book of Selling is a guide to selling. Not only the content of the book, the damn book itself. Awesome stuff. Without any further delay, let's jump right into Harold DeBoer, Howard Marks, and Jeffrey Gitomer. Yeah, guess what? I'm the only person on the planet to combine those three guys into one podcast. Enjoy. One of the things that I love about you guys as a writer of books about trend following is the phrasing, the words, the descriptions that you've used for some of your world. And I love this right here. I just want to quote it. I want to read it. Our investment strategies are guided by the footprints left by people running after ideas. That is, the prices they set in the market. It's all just an idea. It has no impact if nobody buys it, nobody uses it, nobody votes for it. But every time people do run after an idea, the world changes. Our world is shaped by people running after ideas. Now, I have to be perfectly honest. I would have loved to stole that line and just pretend it's mine, but I can't because you guys already have it. But that's a great descriptor as somebody who's tried to describe this subject for a long time. Speak to me about that, the notion of the idea. How did that come about?
I wrote these lines when I was asked to explain in short what's really the idea behind what we are doing, behind trend following. And I like to do that in terms that is not too technical. And the fundamental thing behind it is there's a lot of people, economics, who believe in a kind of world turning back to equilibrium. So prices can be temporarily high, but they will come down again. The prices can be temporarily low, but they will come up again. Like there is a kind of reversal to a constant state. But if you look at the world, there has never been a constant state. It's constantly a temporary constant. Look at the big developments we have. Like in the Netherlands, until 100 years ago, people didn't drive a lot on the roads. Traveling over water was the main way of traveling. So if people invested at those moments would have said, well, now there's roads are coming and people are more and more using horses and carriages and later on cars or even trains, it will come back to the equilibrium of people mostly using boats. That, of course, was wrong. It's a normal development. And these developments, these very big developments, are happening constantly. And that is the main driver why there are trends in markets. Because things are really changing. So nowadays, last few years, you see a big move from people driving cars driven by gasoline towards electric cars. This has a big impact because that means that just simple things like in a car, which is electric, is 3 times as much copper as is in another car. And of course, this has a big impact on the market. It means that there's more need for copper than there was before, and there's more need for all kinds of other metals. And this is not something that will revert. It's a new development. It may be in 50 years' time, people are not driving electric cars anymore. We are driving something completely different. But it's no way that it will turn back to the cars we had 20 years ago. So it's a constant development.
You know what I like about your descriptions, the way you guys describe yourselves, is that unlike some people that you might see in the quote industry, they will talk about the statistics behind something. They will get into the very academic aspects of something. Now, don't get me wrong, you guys have your academic and you have your statistical chops as well, but you guys seem to do a fantastic job of describing what you're doing in the trend following world from a very kind of hands-on approach, a very kind of way that the average guy can approach it. And again, like I said, very sophisticated, statistically based strategies, but from the ground up, philosophically, you're clearly very comfortable explaining things in everyday terms.
Yes, I have to thank my professor for that. Finalized my study mathematics in specialization in statistics. And this statistic professor was really about first knowing what the thing is about and then start to use the mathematics, the statistics, and not the other way around. He was really an old school professor that first had worked in the industry, in his case, not in the financial industry, but other industry, but he first worked in the industry, saw problems there, things that had to be solved, and then recognized what kind of statistics would fit with that. And if that statistics didn't exist already, he would make it. And based on that study, he became doctor, we say in the Netherlands, a doctor in the statistics, and then he became a professor. So first look at the real world, then choose the techniques, and then do it. Then apply the techniques. And what happens a lot is that people start with the techniques instead of start with what thing is going on with the world. If you look at the world, there's not many markets for which it is reasonable to assume that there is a linear relationship between those markets. Well, if you start your research, what many people do for correlation with all kinds of linear correlation measurements, you have made a mistake already. And you can keep on doing calculations, but the problem is using a linear correlation measurement like that of Pearson's, which is the most used one, already assumes that any relationship will be linear, while there's absolutely no reason to assume that it will be linear. So those fundamental choices are very important. And we often have discussion whether what we are doing is technical analysis or fundamental analysis. But it starts with fundamental analysis, meaning on a fundamental basis, decide which techniques can be used. And only then you can use the technical analysis. And then it becomes pure technical. But it starts with a fundamental basis, which is somewhat opposite to what some other people are doing. You see more traditional finance people kind of turn it around. They kind of start with the technical element and then make a fundamental story, which is just the opposite way.
You mentioned the statistics professor. Let me take you back in time. Before that, I know just a little bit about your early life. I know growing up on a dairy farm. Give me, if you're sitting around with your buddies and friends and they kind of know where you are today, but what's the connective tissue to growing up on a dairy farm? How did that shape you in terms of your world today? Because I'm sure there's some connective tissue there.
Oh, there's a lot, because a cow herd is changing also, and there's a lot of developments in the cow business too. Let's say the Netherlands used to be ahead with the milking cow. The dairy cows in the Netherlands for a long time had been kind of internationally seen as the best cows in the world, which was true until the 50s and maybe till the 60s. And then many countries were importing cows and calves from the Netherlands and crewing them, for instance, in the US. What happened is, while the Dutch were keep on thinking that their cows were the best there is, and they were only looking at all kinds of elements like how do they look like, all kinds of non-relevant issues, the cows in the US and some other countries were being bred in a way that they were producing much better, and they were growing such that they would much less diseases. They were much more efficient. And then in the 70s and 80s, the first farmers realized in the Netherlands, hey, we have made a mistake here. My father was among those farmers that started to use the sperm from US bulls again to improve the cow species again. That's something as also a development. And such a thing, how do you look at genetics? And behind using genetics is a lot of statistics. So my background in statistics is really coming down and really started with looking at the genes and how that reproduces in cows.
So the real world application right there of your math background is taking place on the family farm.
Yes, I learned statistics from how it happened with cows and calves and collars and all the genes. And then later on school, learned the statistics from the statistic book, and they fit it. But that's the way I learned it.
So basically, for any of the potential competitors, the young guys or young gals that might be listening, you're basically saying, hey, hold on, you might not exactly get the education you need to compete with me at the academic universities. You might need to go to the farm.
Not only the farm, it doesn't even matter where it is. Just look in the world. I grew up a farm, and I was with it in the cows. But if you are, let's say, a railroad company and you see what happens there, you will see a lot of mathematics too. So it's everywhere. But start with looking at the world and see what's happening and see what kind of structures are there and what kind of developments are there, and realize that it's developing things. Well, we have the story also on the website that if you take a picture from 50 years ago, you will recognize it's a picture from 50 years ago. And there will never come a time that this picture can be taken again, except for in Hollywood and some other places where they can redo the history again. But apart from that, the world is continuously changing.
As you lay that scenario out, you've got the math background, you're looking at the real world, we've got the farming background, you obviously you start to know about commodities. What's the transition? When is the first time? Because we're talking in the 1980s. When's the first moment that you said to yourself, or how did it happen where, okay, I'm going to go into trading. And not only am I going to go into trading, then there's some kind of germ, a light bulb moment where you say, okay, there's this trending behavior that's really interesting to me. Lay that out for me. Lay that story out for me. How did that happen for you?
My professor said that to finish my study, it was best to find somewhere a real life problem. That was in the years that internet was not yet there and email was not there. So I had to write letters to all kinds of firms and ask them if they would have any problem in which it would be interesting for someone with a mathematics background to finish a study on. And I got two very interesting possibilities. One was with a dairy factory, and the other one was with this trading firm that traded agricultural commodities. And with my background, I was thinking, okay, later when I grow up, I will be working on a dairy factory. So I keep that one for later when I'm adult. And for now, I will have a look at this trading firm because this is something that I don't know yet anything about and it's good as an experience. So that's why I choose that one. This was a trading firm, traditional agricultural commodity traders. They were transporting them. They were crushing soybeans into soybean oil and soybean meal and so on. So it was really a traditional commodity trading firm. And what they saw is that on the futures markets they used the commodity futures markets, they saw that more and more so-called funds were active there. To their astonishment, those funds never took delivery and never did anything in the market, but still made money. And they said, well, if these people are able to make money in our markets, then we should be able to do that ourselves too, on such a more technical or more quantitative way. And that's where the project started. And I came to that project to finish my study. And it was a very interesting project. And we did all kinds of different things. My first research there was looking at the relationship between meats, so cattle and hogs or feeder cattle. In those days, you still had pork bellies, and not really anymore, but pork bellies also, in combination with the grains and the feeds, so soybean meal, corn, and so on. And there are all kinds of interesting relationship between those markets, and I studied those. And from that, we saw that there would be a way to do some kind of arbitrage type of strategy in those. But looking deeper into the strategy, we realized, okay, it can be very interesting, such a thing, to do that on a more fundamental, semi-fundamental, or semi-technical way. But there's a big risk because if you're wrong, it can be going wrong heavily. And this is, of course, a big disadvantage for all kinds of arbitrage strategies. On the same time, we were doing all kinds of other analysis. We were testing all kinds of strategies that we've been written about and that are traditional technical ways like trend lines and so on. And we were testing other strategies too. And then we found out that trend following type of strategies were very interesting. And one of the reasons they were most interesting for is that other than these arbitrage and more quantitative things, with these trend following way of things, you can trade many, many different markets at the same time. You can really have a large diversification. And where with this arbitrage thing, if you are wrong, the only thing you really can do is make your position larger because you think the markets will come together. The trend following way is just the opposite way around. It's If you are wrong, then you get out of your position, or you even revert, you go the other way. And this way of trend following also much better fitted with the idea that the world is changing again. So all kind of relationships between markets can really fundamentally change. And arbitrage strategy is much more difficult than that. So recently in Europe, we had this issue with a trader in Norway that lost a lot of money by a spread between the German power and Norwegian power. While underlying that thing, there was an arbitrage trader, but underlying there was a fundamental change in Europe, which had to do with the price of emission rights, for instance, and with the change of climate. And such kind of fundamental change really undermines such a strategy, the arbitrage strategy. While in trend following, such a thing is no issue at all. It's a very interesting thing. The emission right trend this year is one of the best trends this year in the markets. So looking at this market and looking at these different philosophies and this different way of treating markets, we found out that trend following is really good. And the best thing about it, that is so great to use in a diversified way. Then we had to solve one issue because the company we worked within had really chosen to only trade commodity markets. You have to realize this idea started just after 1987. 1987 was not really a good year for investing in stocks, to use an understatement. And they decided, whatever we're going to do, we never want to be in financial markets. And then we said, well, with this trend following way, you can also trade all these financial markets and you even get much more diversification. So we had to explain to them why it would be wise to do the same thing in financial markets. That makes us kind of different from many traditional hedge funds, because many hedge funds, they start with financial markets and they have a background in financial markets and sometimes use that without really thinking the same strategies in commodity markets. We have really a background in commodity markets, which gives us a complete different idea about how markets are functioning, and especially when you look at the time structure and old crop and new crop, that kind of things. These things are very relevant for commodity markets. And with that background in commodity markets, we are applying it also in financial markets.
Let me keep you at that point for a moment, because I was thinking, okay, I wanted to ask you about this issue. You start off in the commodity markets. Was there ever a moment for you, given that you had to start in the commodity only markets, did you have the trend following feeling for all markets, or did you start at commodity markets and say, well, we can apply these to other markets? Or did you always know that these techniques could apply to the full global suite of markets out there?
We didn't realize that it could be done for the full markets out there at that moment, because now there are markets that were not out there at that time. So let's say stock indices were pretty new. The stock index futures had really started. 1982 was, I think, the S&P 500 was the first one. So there were not that many stock market futures. And of course, absolutely no sector indices, single stock futures. Those things did not exist at all. But currencies were being traded, bond markets were being traded. So those markets were very good to use these techniques in. Later on, we realized that you can do the same thing with sector indices and with single stock futures, but also with emission rights and those kind of new markets that all didn't exist in those years. And I think it's very relevant to keep on being active in new markets, because I remembered in 1998, I think, maybe a little bit before that, we decided that we were wanting to trade the Nasdaq futures. And our, at that moment, largest client said, why would you want to trade such a small market? And we said, well, it may be small at this moment, but maybe it grows. And I think there's absolutely no one nowadays that would call the Nasdaq future a small market. But really, that was a new market at that moment. Something new. Can you really trade it? Is it going to last? Well, it is.
And hey, roll forward to modern times, because we're talking about events in the 1980s, the early 1990s. And here we are in 2018. You guys trade, 500 plus markets, yes?
Yes. But that's not relevant. Because, yes, there is 500 plus markets, but at the same time, you have to realize that the real number of different trends going on is smaller than that. So at this moment, you have an energy trend, and you can say, well, we're trading heating oil, and we trade unleaded gasoline, and we trade oil. But look, a day like yesterday, all these markets come down. And that's something you know. The real amount of markets, in the past, we were really saying the more markets, the better. And it still is true, you need diversification. But you also have to realize that the real diversification is not measured by the number of markets, but by the number of really different underlying developments underlying trends we can be positioned in.
Let me keep you at that word for a moment, trend. There's another great line that I've seen come from your world that I think is great. Price trends are as inherent to markets as the wind is to the atmosphere. I love that one. I love the way of just getting people to think about trends and movements because, when I'm going to go into it in a minute here, I'm going to ask your opinion about factors, and the academic world is trying to find assorted things out there, but again, gets philosophically away from what you've grown up on, from what you guys have done with your firm, is to stay very grounded and say, hey, these big trends exist. They come from sound reasons. We can look at why these things start to happen, but they're unexpected. In fact, you know what? It's probably a great moment to actually jump right into the notion of factors. I find it quite interesting. What is your view of factors? The notion that the academics have said there's a factor for momentum, there's a factor for value, and you can just isolate it and find it in a back test and apply $100 billion to it.
Yes, there are factors, but those are not relevant factors, those ones. The relevant factors are, of course, if OPEC is doing something, that has an impact on oil price and on the price of stocks of all firms and of the price of the Norwegian krone and that kind of thing. OPEC is a factor. A central bank policy is a factor. People thinking about environment and want to pollute, yes, or governments that decide they have to pollute, yes, is a relevant factor. Those are factors. And those academic factors are academic, meaning not part of the real world. And I think when you talk about investing, you should explain, okay, we are buying copper now for this and this reason, and that is not because of momentum or because of value or whatever academic factor. No, you have to realize what is driving copper prices, and are we able to profit from that? And what's driving copper markets? Of course, when many investors are following those factors, then that factor does become a short-term factor. However, will generate a price movement that does not fit with the underlying markets. Because when investors are buying more and more copper for some kind of academic reason, instead of a real life reason, that doesn't mean that ultimately the consumers will use more copper, or the producers will use more copper, or that there will be less production of copper. So the idea why people are buying and selling things, if that doesn't fit with what is happening in the underlying real markets, because ultimately it's all about the real life markets and not about these futures, which should be looking at the real life markets, but not the other way around. When that doesn't work, then but those factors are not relevant. The relevant factors are what's really happening.
Does it kind of make you smile sometimes as a man who's been in the markets trading for 30 plus years, when you see some of this new branding coming around where everyone all of a sudden, and it seems like all of a sudden almost, where factor, and everyone's talking about it. Do you sometimes just sit back and smile to yourself about the branding on Wall Street?
Yeah, but branding, of course, you also have to realize that branding can become by itself a factor, which can really impact markets. Especially nowadays, you really have to understand that the way markets are being driven also is to a large extent by factors that should not really drive markets, but they do so for a short moment of time. And whether you talk about a flash crash, what is really the outcome of people doing something and nothing else than that, or a somewhat longer term disturbance, prices can really go away with a serious force because of money flows, investment flows, that are not driven by what's really happening in the underlying markets. But that force can be very strong. That also means, because now often people say, well, let's say an active investment style, even a fundamental style, should be able to make more money nowadays because of the big amount of passive investors, the large amount of passive investors. But that's not true, because the power of all these passive fund flows is so large that for a fundamental investor, let's say a fundamental or active investor, you have to be able to withstand that force, because this can drive the market for a long time in a wrong direction. Ultimately, it will go in the right direction, but it makes it more harder for active investors. You have reached a point in which there's so many passive investments that are really driving markets that makes the markets more difficult to trade for the active traders, which is a problem, because it means that if the active traders cannot really have a big impact on the markets can really go away in the wrong directions for a short moment of time or for a longer moment of time, which is not really healthy for the economy as a whole.
Do you ever have moments where, as we are talking about assorted factors and you're laying the foundation for why many fundamental factors are useful to know, useful to understand. But when it comes to your decision making is made off the simple heuristic of price action. Price action is what drives you.
Yes, we have to, because we are not a fundamental trader. So it's not that we say, okay, from a fundamental point of view, the price of cocoa is too low at this moment, so we will buy. No, we will buy if there's an uptrend. But we do realize that there can be a significant uptrend when the market has been too low for a long time, which happened, for instance, earlier this year in the cocoa market. That all has to do with to what extent does the market as a whole still function. Market participants have an important role in that. And if more and more market participants start to behave in a way that does not really match with the underlying market, they do have a big impact on the market. And that's something we have to take into account. So let's say a Tesla stock, you could say from a fundamental point of view, why is a Tesla stock has been rising so much while the company never made a profit for many years? Well, it's because the thing came in more and more indices, and passive investors have to buy the thing. So because passive investors are buying it, they buy more, it comes in larger indices, it becomes bigger in the index, and passive investors have to buy even more. Ultimately, it's very hard to stop such a thing. Well, this year, finally, Tesla did make a profit, I think, last quarter. But that thing is not driven by really what Tesla is doing, how well they are really doing. The most important driving factor here is getting in more and more indices, and as such, it will keep on growing, which is something you have to take into account. It means that you cannot go short a company or short any other market as long as there is so much power driving it in the other way, even if you fundamentally would say it's being driven in the wrong way. It's good to see why it works. And we very often have positions in which you would say, well, fundamentally it doesn't fit, but there's so much force driving this market on this side, we shouldn't go the other side. We are not the ones that can, the people running after ideas, that's what is happening. Let's say Brexit, for instance. We can say it's a very bad idea for the UK. Well, it doesn't matter whether we think it's a good idea or a bad idea. The thing is, it's happening, so it will impact markets. And we have to take that into account. We will have to take into account that these markets are driven by people running after that idea, that they think is generally happening. If people vote for something because they believe in it, then it doesn't really matter anymore whether the thing that the ones that are, whether it's the president or whether it's a movement like Brexit, it doesn't really matter whether what they say is true. It's all about whether people are running behind it. And when people are running behind it, it will have an impact. It will create trends in markets, but it will have an impact in the world as a whole.
To follow up on your point there about Brexit, yes, you can have a personal opinion about Brexit, but that opinion is not factoring into your decision-making for the funds that you are trading.
No, but it does have a role is when things like this are happening, then we are looking at, okay, what kind of effect this can have and how do our systems work? Is there elements that will not be taken into account by our correlation measures or whatsoever? So is there any place, anything that could happen, the way we work, that's not right for? And it can be very simple things in are we trading the right markets and so on. We have to realize that things are happening, and we have to realize that can create trends. And we also are evaluating whether what we have been seeing does fit with the underlying idea. So the Brexit election was a very nice case. And in many aspects, what we did was exactly what we expected that we would do and how our systems would respond to such a thing. But there were also a few surprises in there. And some elements, if you said, well, okay, this happened now, but next time with election with some strange outcome, unexpected outcome, something like that could happen again, and we could improve our way of handling with these things, for instance, in execution. So we did make some changes on the way we execute orders in very volatile environments after Brexit, and we profited from that when the outcome of the US election when Trump was chosen, because again, then in that night, there was some erratic market moves in all kinds of markets, which we could better profit from because of changes we made after evaluating what happened after Brexit.
Let me keep you in the word trend for a moment. I want to quote from your world. I want to read this. I think it's a great small paragraph, and I'm going to let you explain it even more after I read it, and we can kind of break it apart. But I want to read this. This is great. Trends in particular, those that are most profitable for trend following systems, like those in DTP, your program, are comparable in a number of ways to burning haystacks. Once such a fire is broken out, it's often hard to extinguish. The same applies to price trends. But equally important, a haystack normally does not start to burn all of a sudden. The fire is typically preceded by so-called self-heating, a fermentation process whereby the temperature gradually rises, starting at the core of the haystack, eventually leading to spontaneous combustion. Now, that is another one that I wish I wrote and I could put in my book already. I wish I could steal it from you, but I can't steal it from you because everyone knows it came from you.
Yes, that's really a thing that we worked on when we saw in 2012. In the second quarter of 2012 was a period in which normally you would expect a trend following strategy to do very well. There was a sell-off in especially emerging market equities that then went over to other markets as well. There was typical kind of movement that you would say, okay, a trend following strategy should be doing very well. And we made some money there, but we realized this is not enough. We should have been doing better in this environment. And then we tried to figure out what was happening here, what was going on. Then came this picture, okay, what was different here from previous periods? And that's this combustion thing is happening a lot. The story I think we wrote there is about the Russian situation in 1998 or 1997. The oil price had been going down for a long time for obvious reasons to be found in the oil industry. But for Russia, this was a big problem because Russia was very dependent on oil. So there was a big trend in oil. And because of the trend in oil, Russia came into problems. Until that moment, most investors in Western Europe and in the US and anywhere in the world were not really watching what is happening in Russia. It was not that people in the morning entered Wall Street and were thinking, well, let's first have a look what is happening in Russia before we start there to do any stock trading. That's not the case. No one was really looking at Russia. But then Russia came into a problem and became a crisis. And all of a sudden, this Russian crisis impacted all the market at that moment. That's when we say it's a fire and it is combusting, and then it's impacting many, many other markets, even markets in which it really should not be impacted at all. That's the thing that's going on. These kind of movements can create big reverses in some trends. US stock market can suddenly come down too because of a Russian crisis. And as a trend follower, you normally will not profit from being short the US stock market in such a situation because it was not going on there. Where you can profit from is being at the source of the event. In this case, being short in the oil markets. That was what we were. And this oil market in that situation was at the basis of thing that was happening. To make sure that you make money is you have to be sure that you're positioned at the basis where the thing is really happening. For instance, this year in the summer, the Turkish lira had been declining for a long time. And this was a typical Turkish event. It had nothing to do with things happening elsewhere. It was just a local Turkish event. And all of a sudden, one morning at 5:30 our time, I think it was the Financial Times that wrote an article about European banks that would have problems because of these Turkish things. On that moment, there was a sell-off of stock markets worldwide and also of emerging market currencies, above all in South America, for instance. That, of course, had nothing to do with what was happening in Turkey. And the thing in Turkey was going on for a long time already. But just this one thing, this one story, triggered the spreading of this fire to all kinds of other markets. At that moment, we held long positions in the South African rand and were losing on them because all of a sudden the rand was coming down because of Turkey. But to profit from such a thing means you have to be short Turkey because there it was going on already. We had very large short positions in the Turkish lira. That's at the basis, that is where the fire started, where it was going on. That awareness, that's so fundamental, that's so very important, has been the basis for many changes we've been making further on to make sure all kinds of choices we make in the programs have been made such that the chance is large, very likely, that we are sizable positions in any haystack that could become the next haystack causing the big fire. Because we have to be in that haystack and not in the ones that is being infected, because the ones that are being infected, you probably are on the wrong side.
I like how you describe a gradual start of a price increase or decrease, and you describe it as the self-heating. The self-heating is the well-informed insiders making moves. You know, when the average person sees a little bit of an up move or a little bit of a down move, they're not necessarily drawing much conclusion from that. But a price-based approach like you employ does draw a conclusion from that.
Yes, we have to make sure we do, because that's very relevant. And if we don't do, we are on the wrong leg. And when we are on the wrong leg, we are losing money. And it has become more difficult to do this. And this has to do with a broader change in the world. let's say until 15 years ago or something, all traders didn't know everything about oil, and they were really reading everything about oil, and everything was relevant for oil. People trading Canadian bonds knew everything about Canada, Canadian politics, Canadian monetary policies, and for that reason, they were really well informed in that. People trading soybeans knew everything. Let's say our former parent company, they knew everything about soybeans, and they were really not interested in monetary policy in Canada or other things. There's a lot of specialized people, and information was within that group. You still saw it in 2007, 2008. The credit crisis really started in 2007 in the interest rate markets, and it took until 2008 until it really infected the stock markets. Now, information is being spreading via internet and social networks and so on. The effect is that there's much more information available to much more people at the same time. And you would think, okay, if people have more information, they can make better decisions, but people are selecting. And what's happening is that more people are looking at the same thing. So for a short moment of time, earlier this year, many people were only looking at Turkey. It took only a week. In the next period, many people are looking at other things again and forget about the other things. So people trading oil maybe should not look too much at Turkey and should keep on focusing on the things happening in the oil market, because that can be more relevant for the oil markets. If this thing is happening and people are looking at the same thing at the same time, this local self-heating will be less visible, because the people that should be trading oil or that should be trading corn or trading corn are not enough looking and watching the factors that are really running the corn market, and instead are too much looking at other factors which ultimately are not that relevant. And it means that this really relevant factor for the corn markets are not coming into the corn markets until it becomes really a problem. What happened in 2012? All of a sudden there was a drought, but a drought doesn't start overnight. A drought is slowly growing. It is not that it stops raining and tomorrow you have a drought. It's something that is really developing. And in a well-functioning market, there are enough people, informed people about the corn market, that see this drought going on. And as a consequence, the price of corn will rise. If that doesn't happen because people are too much watching the few storylines that are running all the media at that moment, then the corn market is not developing well. And it's harder to recognize the trends. And this is one of the things that makes trend following more difficult the last few years. We have to make all kinds of amendments to make it better again.
As you mentioned, the difficulty from your perspective, and I'm thinking about your short-term perspective, and I'm also thinking about the notion of you don't work under a benchmark pressure, is my understanding. So let's talk about the benchmark part of it for a second, though. How has that unfolded? Now, listening to you for 45 minutes, I can see there's a very sound philosophy from the ground up. You've got a perspective, but hey, investors are often irrational. I'm assuming you've probably trained your investors very well. And of course, you've had performance for a long time. So that helps a lot. But speak to the idea of benchmarks and how you have allowed yourself, your firm, to steer clear of benchmarks, because benchmarks psychologically can really cause harm, can't they?
We, of course, as CTAs, we have much less problems with benchmarks than traditional stock investors that really are trying to stay close to a benchmark and then they'll trade the markets because of that. But it also had, I would say, a negative impact. Let's say in the 80s, there were some CTAs, especially some US CTAs, that were very successful, but they were not really recognized in the broader investment community. Institutional investors and so on would not invest with their CTAs. Coming into the 90s and especially the early 2000s, when we had some stock market sell-offs, institutional investors realized that trend following strategies could be okay. And then what kind of happened is that trend following was started to be seen as an investment style. Instead of many different traders that do similar kind of things and all of them doing well, it became a kind of the style. Instead of people deciding to invest with John Henry or Campbell, to name some of the older names, investors decided to invest in trend following and then had to find which name to invest in. That didn't make things ultimately really better, because the essence is that there is difference between those investment managers. And it's really important that investors realize the differences, because a trend following style is not just doing the thing and do exactly the same thing. the trend following style has become successful in many years for the 80s and 90s, amongst other because all these investment managers were doing maybe similar things, but also a lot of different things. And their difference, their variation, made them strong together, which is generally true in nature. If you have, let's say, dogs too much look like each other, the species isn't very healthy anymore. Well, that also happened in the CTA industry, in which it became very important to be aware that you constantly have to make the decision which is the best decision from your point of view, instead of being some kind of pulled into an investor demand of doing exactly what people think that trend followers are supposed to do. We did not become a success because we did what we were supposed to do. We were successful because we did what we think was the best thing to do. And if I go way back in history, when we did the first studies on trend following, we found an article that says there was 3 things very important in trend following. One is you should always be in the market. Second thing is you should always trade at the same size. And the third thing was you should always use stops. And when we did our trend research, we found out that trend following was really great, but you should not always be in the market. You should not always trade the same size, and you should never use stops. So we accepted everything except for the 3 being recognized as the basic things. And we once were, those years, at a conference with investors that happened in Italy, and I was there with one of my colleagues, and we were walking to the lunch, and there was some potential investors walking in front of us. They were talking to each other and said, those people behind us, they are from Transcend. They are good. Yes, the other one said, they are good. But then the other one said, yes, but they don't use stops. That's bad. Yes, that's bad. And that was good because those investors didn't decide to invest in us because we didn't use stops. We said stops is a bad thing to use. And in the last years, when, let's say, trend following kind of becomes a style in which there's a lot of stories about what trend followers are supposed to do and what they are not supposed to do. And you also see this with these independent advisors that are also then do box ticking. Are you doing this? Are you doing this? Are you doing this? It kind of drives investment managers to do things that are not really the best things to do. So it's a decision to say we don't use stops. Yeah, if you being selected based on a box tick that says trend following CTA has to use stops. They don't use stops, of course, we will not invest with them. That's a bad thing. It became unhealthy. The last few years, I see some developments in making different CTAs more different choices again. And I think that's very important. CTAs have to explain what they're doing. And there should never be a list that says this is what trend followers should be doing, because there's nothing that trend followers should be doing. They should be studying the market and do the best to make money. But there's no rule like they should be using stops, or they should be using crossover strategy, or they should be using momentum, or they should be using a value at risk measure that is defined such and such way. Absolutely not.
So you guys are systematic. Have you always been systematic? Going back to late 80s?
Yeah, so the research project when we did, some of the things were based on more fundamental strategies. And we founded our research by doing fundamentally based trades. So the first trades we did in the markets were really sizable trades. But nowadays you would call them macro trades in commodity markets. So we were trading. My first research was about developing of hawks and how they responded to a drought. In 1998 there had been a drought. What impact does this have on the amount of pigs and the amount of corn? And what kind of price move then can you expect? And because of that, we decided to take a big long position in hawks and make $1 million with that. And from that, we could do our research for a long time again. That was the way we started. But we did so to finance, the right word here, yeah, to finance our research. And the research ended up into doing everything systematic. But always keep in mind the background underlying market.
I think it's a good point that I'm bringing up to buttress everything you've said, because you lay this foundation of knowing how things work to then use those real life factors to apply a trend following approach. But I think somebody listening, not knowing that you're systematic, then that throws another wrinkle into it too, that yes, you can be a very opinionated man, you can have these very strong views, but at the end of the day, your system is written down, it's coded, and you're executing in a systematic fashion.
Indeed. And this is very important nowadays in the position, because we want to make very clear look, what we are doing is not because we read about some rules and apply them. No, what we are doing, we are watching markets, studying markets, and based on that study, we choose techniques and we systematically apply those techniques. And that's different from we start with techniques. No, we start with watching the markets, developing techniques, and apply these techniques in a systematic way.
Everything we're talking about in this conversation, all the academics, I mean, I guess there's been some change in the last handful of years, but for the longest time, you could see the academic papers, you could see the Nobel Prize winners. They were telling you for the longest time, Harold, markets are efficient and you can't be doing what you're doing. It doesn't work. It doesn't work. And here you are for 30 plus years, just kind of scratching your head. I seriously doubt you're scratching your head. You've probably been very happy with the direction you've gone, but it's got to be interesting to watch this community of folks across academia and Wall Street talking about efficient markets over the course of your career.
The academics now have turned into a complete different direction. I wouldn't even want to call them academics anymore, many of them. Look at the amount of articles that is being published now that are really nothing more than backtest results. If you did such a thing in, let's say, 20 years ago, and you wanted to publish something like that, all these articles you can read, there was a discussion about whether you had to take into account 1% price impact or 1.5% price impact. That was what the discussion was about. And the outcome always was, okay, it may seem like you can make money, but if you take the cost into account, the market impact into account, there will be no result. Nowadays, 10 years or something, it happens more and more. You see articles being published which assume no market impact. And the story there is, well, markets are efficient, and markets are the liquidity is very large, and because the liquidity is large, you don't have to take into account any market impact. I don't see the academic thing behind that, because then I want to hear an academic story that explains me how then do markets move and how then do prices move when it is not because of and due to impact of people trading these markets. I can't find reasoning, because market impact is the only thing that moves markets. And that's the role of investors, is to be aware of that and to be aware that they have market impact and that they are the ones that are making the market. They're not the ones that can make profit out of the markets and the markets themselves will automatically go in a certain way. No, all the market participants are making the market. They make the market go in a certain direction, and all movement is market impact. So these academics that kind of say, well, look, it happens automatically and you can just do this and this and you just apply it and this will come out. That doesn't function. It doesn't function because it neglects, it denies the element that markets are being moved by what people are doing in the market. Look at a stock like Apple. People may think that the price of Apple stock rises when many people are buying their iPhones. But that's not what is happening. They can sell lots and lots of iPhones, but if no one buys the stock will not rise. The stock only rises because people are buying the stock and are willing to pay more for the stock than they were willing to pay before. And we all hope that people do so because they expect that Apple will sell a lot of iPhones. But if they forgot that element, then the price will not move at all, or the price will move in another direction than what the ultimate results of the company Apple is. So it's all about market impact. Market impact is the only thing that moves markets. And to us, as an investment community, we have to take that into account. We have to be aware that we should never neglect the underlying market.
It's got to be comfortable is not the word, but given the longevity that you've been in the trend following space, to have a foundation, to have a real world record that people can look to. I mean, of course, the past is the past and we don't know what's going to happen in the future, but we can draw a little bit of inference from a long track record. It's got to be interesting to some degree to see so many academic folks, and I'm not saying they're bad people or anything like that, not saying they're not smart, but quite a few academics have gone straight into fund management with all of these papers and have raised a lot of assets on techniques that might not be the best thing in the future.
Oh, no. I recently gave a presentation about responsible investing in commodities. There is a lot of investment managers that are offering long-only positions in commodity futures. And some of them present all kinds of semi-academical stories behind why being long in a commodity future would give you some kind of risk premium. These stories are just completely wrong. And they can prove wrong. If you just look what happened if you would have been long wheat from 1970 onwards and keep on rolling. It's not rolling cost that people can say, well, it's because of the rolling returns you're losing. No, it's not. From day to day to day, there's a risk premium normally being paid by the ones that are long and not by the ones that are short. And there's a fundamental reason for that. So all these semi-academical stories that say, well, you can invest long only in commodities and you can do like this and you will get a risk premium, and often they address to Keynes. There's one basic rule for anyone that wants to invest in commodities. If some investment manager visits you and tells you why his strategy works and he refers to Keynes, you can be sure that 1, he did not read Keynes. 2, if he did read Keynes, he did not understand it. And 3, he does absolutely not what Keynes was referring to. So such an investment manager will surely not make any money on that strategy. So the best way to recognize a bad investment manager in commodity markets is someone that refers to Keynes. The best one I once saw was an investment manager that was telling about referring to Keynes' cost of carry model. Maybe you know the model, but the idea is the cost of carry model is based on the idea that you have a commodity, you can store it and then sell it in a later moment, and the price between the futures now and the futures in the future is the cost of carry, the amount of money it costs to store that commodity. And I saw an investment manager that gave a story about it with reference to feeder cattle. Well, feeder cattle has to be alive, and I think out of my head between 3 months and 6 months in age. And I don't think there's any way you can store living cattle, calves between 3 months and 6 months in age, for a year, and in a year time they're still between 3 months and 6 months in age. I don't think the cost of storage will be extremely high to make that happen. There are some people that would like that they could get 1 year older without getting older, but it's completely impossible. And using these kinds of theories and apply them to things that they are absolutely not connected to, it's bad academics.
Do you perceive any advantage over the course of your career where you have been based in Rotterdam, in the Netherlands, being Dutch? Has this been an advantage to you from your perspective?
Sometimes it has, sometimes it has not. Let's say for potential investors, we are farther away. And what often happens is that potential investors are, let's say they are visiting London and they can then visit many investment managers in a few days' time. They visit 5 in a day and then make a trip and they visit 15 investment managers. And of course, they will not visit us in the Netherlands or our colleagues in Sweden or our colleagues in Paris because they are further away. The advantage of that is that the ones that do visit us are more serious. So that means the amount of time we spend with talking potential investors is smaller than others because we don't have these ones that are not really serious. There's one advantage or disadvantage, just how you want to name it. Another difference is with the staff we have. We are not competing with people that can choose for another firm that is around the corner. The people that work here, they have chosen to do this, and the alternative is do something completely different. Most of them would not even be working in the financial sector. This is an advantage too. So the students from this region in the Netherlands in generally, if they want to do work for a CTA or a hedge fund, they have not that much choice. That's an advantage. And another thing is, which helps is because of we have different people than other CTAs, we also are better in having our own ideas. In London, you see a lot of people that have been working for one CTA and then they work for another one and then work for another one. So what often happens is that you see similar ideas with different CTAs. Because we are somewhat more isolated, we are, let's say more like the people on islands in the Atlantic Ocean, still ocean. What do you say? The Pacific, I think it is called. The Pacific. There's the small islands and people are living there completely their own way and have colored faces and so on. Well, we are a little bit like that.
You don't want to be tainted by all kinds of bad influences.
No, it's not even that we don't want, but no, it's the being different and another place helps you to be yourself.
No, it's great insights. I appreciate you giving my audience a perspective. Perhaps we can grab a conversation in the years to come again. I really enjoy the perspective. And again, I'm very jealous at many of the perspectives that you guys have written about because I just want to steal the quotes and put them into a book, but I can't now because everyone knows who wrote them, so I can't steal them. So, but listen, great stuff. Hey, and the best place for everybody to go and check you and your firm out is transtrend.com, correct?
Yes. and look at the philosophy page, because that's where it all starts from.
I mean, look, I've had a chance to speak to so many peers of yours. Probably we have mutual friends that we don't know about. And one day I'm going to have to make it to Rotterdam. We'll have to do lunch. It's been a long time since I've even been in Amsterdam. It's been over 20 years. We'll have to grab a lunch one day. I appreciate you coming on today.
Be aware, Amsterdam and Rotterdam are no friends.
They're not friends.
No.
You want nothing to do with them. You've drawn the line at Rotterdam. They're not allowed over.
In football competition, when Amsterdam plays Rotterdam, the public from Amsterdam is not even allowed to visit Rotterdam.
Speaking of that, if we get a second conversation in the future, I would love to talk to you about your speed skating story. Fascinating.
Okay.
Yeah. So listen, Harold, I appreciate you taking the time today.
Okay, thank you.
So I was thinking, the next Howard Marks, he won't get to the same kind of success as the first Howard Marks, but there might be some rhyme to it. And the reason I want to go there is I want to take you back in time. Before we get into our main part of our conversation today, talking about cycles, I really want you to lay some foundation of your early career. I've seen you tell this great story where you go ahead and you outline your boss in 1982, telling you something about high-yield bonds. And I thought that was the most fascinating story, and to go investigate this guy named Milken.
Well, it was actually in August 78, so we just passed the 40th anniversary. I had been an equity analyst and then the director of research at Citibank for the prior 10 years. It was time to find a new thing, and I was interested in moving into money management. The chief investment officer asked me to start a convertible bond fund. I switched to the bond department. I set about doing that. I was having a great time picking securities. And in August of 1978, the head of the bond department called me and said, look, there's a guy named Milken or something out in California. He deals in something called high-yield bonds. A client has asked for a high-yield bond account. Can you figure out what that is? Nobody had an idea. Nobody knew about these things. I had never heard of them. Fortunately, that was the beginning of the high-yield bond world. Prior to 1977 or 78, it was not possible to issue a bond with a credit rating below BBB. And then, in part, Michael Milken, in part others, created an innovation to the effect that you could issue bonds rated BB, single B, even CCC, if they offered enough interest to compensate for the risk. So that was the very beginning of the high-yield bond world, as I say. A great time to get that phone call. There's nothing like being early.
Can I ask some early understandings that as you started to pick it apart and understand the high-yield space, how quickly did you know that your life had changed? Now, of course, there was many people in Milken and raising capital for so many entrepreneurs across America. How quickly did you know your life had changed and you were going to really get started down the high yield path?
Personally, my life had changed because I loved money management so much more than running a research department, which was an administrative and bureaucratic task involving 75 people and a large budget and 5 committees. Now I was working on my own, ferreting out value, picking securities, and just loving it, even though it was not organizationally important. I think that the recognition of the new meaning came around the mid-'80s, the 85, 86 period, because, when I started in high-yield bonds, the universe consisted, as I recall, of about $2 billion of securities, which is really tiny. Today, it's about $1 trillion. It was an insignificant back alley of the investment world. But in the mid-'80s, the private equity industry really came into its own. The private equity funds began to borrow huge amounts of money to buy billion-dollar iconic U.S. companies like Macy's and Federated Department Stores and U.S. Gypsum and National Gypsum and even Nabisco, RJR Nabisco. That's when about 30 to 40 billion a year were being issued, that's when high yield bonds became financially significant in the U.S. economy. That's when it became obvious that my phone call in 1978 had given me in 85 a seat on the front row of really of financial developments.
It's such a fantastic story. There's so many books that young people can go back today and try and at least give themselves a basic understanding. But I just find some of the early writings from the 80s, the early 90s that really describe the world that you were living in firsthand, such an amazing entrepreneurial account. I mean, so many names across so many industries raising their capital via high yield bonds. Just some fantastic stories. So motivating.
If I can just add, it really was a sea change. Mike Milken, I think, describes it as the democratization of finance. You have a delineation, a point in time. Before that point in time, only good companies could borrow money. After that point in time, any company could borrow money if it paid enough interest to compensate for the risk. And that's a massive change. And that latter attitude made its way through to all aspects of our financial system over the last 40 years, sometimes for the better. You can point to a lot of startups that were financed in part with high yield bonds, or not startups, but young companies that grew into a lot. And you can point to mistakes that occurred, massive mistakes, like arguably the subprime mortgage movement grew out of that sentiment as well.
Let me shift you, because we could talk about your early days for a long time and bring it up to current would probably be where you really want to be right now, because that's the focus of our conversation. And get into the conversation about cycles. I want you to define, from your perspective, a cycle. It's quite interesting. I have to say, going through your book, I was expecting something else. I was expecting a version of cycles that perhaps you might see on CNBC, where somebody says this precise movement means this will happen. It's quite different the way you explain it. I would love for you to define it. And also, if you could add, how far back have you gone to look at cycles?
First of all, there are cycles in science and in phenomena such as radio waves and sine waves and that kind of thing, which are precise, which have a consistent duration and amplitude and speed and so forth. And then there are financials in the world in which, and then there are cycles in the world inhabited by people. And because people are not so regular, the cycles they produce are not so regular. The economic cycle, the corporate cycle, the market cycle, and many others, these things are not as regular as sine waves and radio waves. Richard Feynman, the noted physicist, says that physics would be much harder if electrons had feelings. The point is that cycles in the financial world are produced by people, and they stem largely from the oscillations in people's feelings, which, of course, are not regular. A cycle is an up and down pattern around a midpoint, or it can be likened to the swing of a pendulum back and forth from a midpoint. The point is that the cycle represents a fluctuation in something where the norm might be described as that midpoint. It might be the PE ratio of stocks or the long-term trend in the value of the stock market. But point is, these things don't move in a straight line. They fluctuate around that midpoint, and that fluctuation produces the cycle. Now, I've read about cycles going back hundreds of years. You have to read about history. First of all, you have to know history to understand the world. We don't have the advantage of living through history anymore. Of course, I've lived through 50 years of financial history, but I think you have to go back a few hundred years to understand the swing of cycles.
The thing that I really like about your perspective and how you explain cycles, which kind of got me to come into it, your thinking, it's not just that one is following the other. It's that each is causing the next. And I would love for you to kind of perhaps connect the dots. We have the dot-com crisis, and in a few short years, we have the subprime crisis. These are part of a cycle, And you can argue that they are connected and one caused the other. Is that a fair assessment?
I think the causality is better seen within each cycle rather than in the tendency of one cycle to cause the next cycle. I don't think too much about the dot-com bubble and crash was causal to the subprime bubble and crash. I guess the main connection between the two is that depressed lows of the dot-com crash eventually gave way to, and in a modest way, the recovery from that crash, you could say, caused the subprime bubble. But I think the causality factor is better understood within each individual cycle than in terms of leading from one cycle to the next. But I think the important thing, and I think one of the key themes that I tried to get across in the book comes from a thought which is attributed to Mark Twain, who is said to have said that history does not repeat itself, but it does rhyme. What we do see from cycle to cycle is that the details, the height of the fluctuations, the violence of the fluctuations, the speed of the fluctuations, the duration of the overall cycle, etc., these details do not repeat. They're always different. And so people say, well, it's gone on for 2 years. Doesn't that mean it has to stop because it stopped after 2 years last time? These things are not important. The other thing that does not repeat exactly is the particular reason for a fluctuation or the effects of the fluctuation. These things also vary from cycle to cycle. But what does rhyme is the applicability of certain themes from cycle to cycle. So I think one of the most important points of the book is that when I look back over the hundreds of years, as I mentioned, of history that I've read about and the 50 years that I've lived through, what rhymes are the themes that underlying just about every financial boom, every market boom, are a few things like too much optimism, too little risk aversion, and too much money chasing a home. And if you take those three themes, I think you find that they do rhyme from cycle to cycle.
Why don't you connect the dots to the behavioral thinking? Because ultimately, if we think about cycles, and I think as you explained that citing Mark Twain, things will rhyme, but they're never going to be the same. I mean, it's kind of like us people. We don't take the exact same action each time, but over optimism, over pessimism, these types of things, our human behaviors are very consistent over a long period of time. And you, and I've seen many of your writings, many of your newsletters, you really take that great historical perspective where, I mean, somebody's reading Howard Marks, they're not walking away thinking, oh, I've got the latest and greatest short-term play. That's not the point.
If that's what people conclude, then I'm really happy with that. This is not a get-rich-quick scheme. This is hopefully a way through diligence that people can understand the investment environment. But you're right, it is key is the fluctuation of psychology. This is going to be consistent from cycle to cycle because people are, let's say, consistent in their inconsistency. Here's something to think about. If the stock market appreciates or returns about 10% a year, which it does on average over, now it's been about 70, 80, almost 90 years that the data shows the stock market returns 10% a year on average. Why doesn't it just return 10% every year? Why sometimes 20 and sometimes 0 and sometimes 30 and sometimes minus 10? In fact, if you look at the history, are very few years in which the return on the S&P 500 is between 8 and 12. So if 10 is the average, wouldn't you think that the observations would be clustered around that average and that there would be a lot of years in which the return on the market is between 8 and 12. And in fact, it rarely happens. In other words, in most years, the return is either considerably higher than the average or considerably lower than the average, but it consistently departs from the norm. Why is that? And further, let me add one point. If you look at a company, its value, let's say you look at a company today, its value in 2030 or 2040 does not fluctuate very much. Reports a bad quarter, that doesn't change the terminal value. It's going to be worth in 2030 or 2040 what it's going to be worth. And that doesn't change much as day-to-day developments change. And yet the price of that stock changes radically. Why? Human psychology. The point is that when the economy is doing well, when the news reports are good, when the company developments are positive, people get excited, the stock rises, the stock increase inflames them more, they buy it more aggressively, they get still more excited. There's this tendency for people to feel better about a company the higher its stock price goes. And of course, the converse, to feel worse about a company, the lower the stock price goes. Now, Warren Buffett, who nails a lot of this stuff, says, I like hamburgers, and when hamburgers go on sale, I eat more hamburgers. And we all know that people tend to crowd the stores and buy more stuff during sales. And that's true every place except, well, I shouldn't say every place, but that's generally true, but not in the stock market or the investment markets. Because think of it this way, and I've thought about this a lot. See if you think this is true. You buy a stock at 60, it goes to 80, and you say, I think I'm right, I'm going to buy some more. It goes to 100, you say, I'm sure I've got this nailed, I'm going to double up. So you buy more as the price rises. But if you buy stock at 60 and it goes to 40, people say, I don't know, I better lighten up. My thesis may be wrong. And it gets to 20, they say, I better dump before it goes to 0. In the market, when things go on sale, people like them less. I think this is a universality, and I think this is a consistent theme over time. I'm oversimplifying, but I think that this kind of thinking accounts for a lot of the cyclicality in the market.
That fear of missing out. People don't want to be on the sidelines if their neighbors are doing so well.
That's a very key point that you raise. I mentioned that if the stock rises, people buy more. But what about the people who didn't buy at all at 60, and they watch it go to 80, and they watch it go to 100? The fear of missing out is a tremendously powerful influence. I think jealousy is one of the most powerful human conditions. There was a guy named Charles Kindleberger who wrote a book about the history of panics and crashes and booms and so forth. He said something like, there is nothing so injurious to your well-being as watching a friend get rich. It just kills most people to see other people making money. So, at 60, you either didn't know about a stock or you didn't think it was a great idea. And at 80, you say, okay, maybe the people who bought it have something. But at 100, you say, they have to be right. I'm a dope. Why didn't I buy it? I have to jump on board. I call that process capitulation. Ironically, in the reverse of the hamburger story, the higher prices go, the more jealous people are of the other people who made money from something, and the more likely they are to jump on board. Until at some point, everybody who possibly could buy has bought. That the day that the last person who possibly could buy buys, number one, the stock has hit the highest price it can because there are no potential buyers left. And number two, the scene is set not for a further increase, but for a decline. It's this process psychology and opinion becoming more positive and less positive that causes the violent fluctuations of stock prices around the company's intrinsic value.
Howard, I must ask, going back in time, you've had some fine schooling, Wharton, University of Chicago, but as a young man, did you have these principles and thoughts laid out coming out of fine schooling, or was there a school of hard knocks before you had the ethos in place that you're describing to us now?
Well, that's a really good question. Everybody talks about books like, what I didn't learn at the Harvard Business School. The purpose of schooling is to lay a foundation of logic and basic truths and maybe of how the world should be. But then you get out in the world and you juxtapose how the world really is. And that juxtaposition, I think, is what is so instructive. So it's impossible, I think, for anybody to arrive at their first job, as I did in 1968, with a fully formed investment philosophy or view of the world, or at least one which will last very long under real world circumstances. So I had two events that were very influential. The first, when I started work at Citibank for the summer in 1968 or full-time in 1969, the bank was an adherent to something called the Nifty 50 school, in which it bought the stocks of the 50 greatest and fastest growing companies in America in the belief that they were perfect companies, impregnable, nothing could go wrong, and impossible to price too high. And if you held those stocks 5 years from 1968, the greatest companies in America, you lost 80-90% of your money because it turned out that the price was just too high and it fell to earth. And then, as we discussed in 1978, I got the call which got me into the high-yield bond business. And now I was making money steadily and safely in the worst companies in America. Again, the juxtaposition of those two facts led me to the conclusion that it's not what you buy, it's what you pay. And that successful investing does not come from buying good things, but from buying things well. And that's it. I can't say that a bolt of lightning came down from the sky, or that there was one day on which I realized these things, but it was like a creeping epiphany. Yeah, I mean, if you can't understand the difference between buying good things and buying things well, you really can't succeed in the investment business. The success comes from not only what you buy, but when you buy it and at what price and under what circumstances. That was the real world realization that put my career on the path it has been.
Let me keep you in this space of you pulling together your education post your formal education. I know, at least having gone through your newsletters, voracious reader. I mean, so if you're giving feedback and influence and insight to young people or older people, whoever listening, the reading can never stop, can it?
No, it really can't stop because, number one, you never know everything. I mean, it seems silly to say, but it's obvious that knowledge is cumulative, but you never know everything. If you want to max out, you have to keep learning. And the best way to learn as an adult is to read. You're not taking classes anymore. You're not benefiting from the wisdom of professors. You have to keep reading in order to kind of vacuum up the wisdom of others. You can keep challenging yourself and keep incorporating new insights into your thinking. When we read, we don't just acquire new facts, but hopefully we acquire new ways of thinking about things and we gain new insights. For example, you mentioned my memos a couple of times. In 2006, I wrote one called Risk, and I wrote down everything I knew about risk at the time. And I think that risk, along with cycles, is one of the most important considerations in the investment world. So as I say, I wrote a memo called Risk in 2006. It was complete at the time. In 2014, I wrote one called Risk Revisited. I added everything I had learned in the subsequent 8 years, which I think was a lot. And then in 2015, I was preparing that memo for publication in a book on Oaktree's 20th anniversary. And I had some more insights, including something I read from Peter Bernstein, an investment sage, who had passed away a few years earlier, but I came across a memo on his...
The Remarkable Story of Risk, his book, Against the Gods, right?
Yeah. Well, not his book, but he wrote a book in '07. He wrote a memo in '07, or a newsletter, called Can We Reduce Risk to a Number? We know one of the great differences of opinion in the investment world is whether risk can be quantified and thus used in formulas for calculations, or whether it is just a subjective judgment. I'm in the latter camp. I think risk can't be reduced to a number. But anyway, I came across this newsletter on my desk, and I incorporated a lot from that in a memo in 15, A Risk Revisited Again. I think if I wanted to come back to it, today I'd have more to add because I've read more and lived through more. And it's only through acquiring new inputs, clearly, that we can keep evolving. We either read something and learn from it, or we read something and we try to integrate it into our pre-existing way of thinking, and that adds to it. So you have to keep going. And I think, as Charlie Munger, Warren Buffett's partner, makes clear, it's very helpful to read not just investment books, but history, and not just financial history, but world history, and also science and the arts and so forth. Reading voraciously and broadly is really, I think, the best way to keep learning.
So I don't take you too far off the path of our main part of our conversation today, cycles. I would like to bring up the example of 2008, the crisis, the decline, the recovery. And you make the point in your newest book that the lesson is not that, hey, we can have a big decline and expect a bounce back. But you make the point, and you quote Nassim Taleb, to think about alternate histories, because it did not have to unfold like it did unfold, which brings into the notion of probability. And so I think that's something that, we can get seduced to think, oh, okay, the dot-com crash, then it came back. Oh, okay, the subprime crash, then it came back. That's not really the lesson you want us to take away, is it?
Well, certainly not in the subprime crash. I think we had these subprime mortgage-backed securities, which I describe as fallacious. There just was no substance to these things. They were enormously overestimated as to their value. And a lot of people and a lot of financial institutions invested in levered, structured securities built out of subprime mortgages, enormously overpaid. So many financial institutions put so much of their capital into these things, into the highly leveraged tranches of these things, that there could have been a real meltdown of the financial system. And there could have been a depression like we saw in the 30s. This was the worst financial event since the Depression, but it did not rival the Depression in terms of severity or duration or impact on the average American. But it could have. That's the point. And, you mentioned Taleb, and his book, Fooled by Randomness, I think, has a lot of important ideas, one of which is the idea of alternative histories, which are the other things, I describe it as the other things that reasonably probably could have happened but didn't. You look at history and you say, oh, well, that's what happened. History is indelible. It's reality. Well, you have to understand history. You have to understand that there could have been other histories. And the history that unfolded was not the only thing that could have unfolded. So you sit here in 2018, we just passed the 10th anniversary of the bankruptcy of Lehman Brothers, which precipitated the worst part of the subprime, what's called the global financial crisis. We say, well, okay, that was bad, but we came right back. The markets cratered in late 08 and early 09, but they came back so strongly in latter 09, and they have been so good ever since that the lesson is that we can't screw it up. You have to buy the dips. Anytime there's weakness, just jump right in because it's always going to come right back. I think, as I say in the book, that that's the wrong lesson. It happens that people like Geithner and Paulson and Bernanke did things that A, were very powerful, and B, worked. The next time around, it doesn't have to go as well. The next time around, I don't think the recovery is as dependable and immediate as this recovery makes it look. I think that because things did not have to go as well as they did in the recovery, I think the lesson for government is that they should keep things from going to such extremes. You know, we used to have the expression about the Fed that when the party gets going too strongly, they take away the punch bowl. That is to say, they take actions to cool off the economy and the markets. And they can do that, and they have done it historically. And I think it's a good idea. So, for example, when the stock market is going too strong and displaying what Alan Greenspan described as irrational exuberance, it's possible for the government to raise the margin requirements. So rather than buy stocks on 50% down, you have to put 80% down. And that would cool off some of the speculative behavior. Now, exactly how you do that in a world dominated by derivatives is not clear. But I think the concept is important, and it comes from learning the proper lessons from the last crash and not the lesson that there's nothing to worry about.
Can I interject just kind of one curious question I have? Having watched many videos with you and now speaking with you, you're very pragmatic. You know, you remind me of my CPA. So I want to know, were you, even as a young guy, 10, 12 years old, a teenager, did you always have this very pragmatic personality about you?
On the one hand, I was probably always logical. And I think it's easy for me to think about these things because I think about these things kind of as mathematical proofs or logical progressions. On the other hand, boys develop slower than girls in general, and I think that I was slow to become serious, if you will. I didn't apply the logic I might have had to serious matters. The other thing is that gaining experience, having some success, having the opportunity to think things through to conclusions which then seem to work is very encouraging of the kind of what you call practical approach to life and to investing. And so I think that's how this came about. With the experience I've had and the opportunity to see these ideas work in practice, I think has reinforced the process.
To take you back to a cycle question, I see that one of the favorite things that so many people, when they talk to you, they want to ask you where we are in the cycle. I've seen you say that we're in the 8th inning, but hey, this is not a baseball game and we can go extra innings. So I guess my question really becomes, with all of your writings out there, and you're a pretty extensive guy, a lot of, voluminous works, why do people continually come back and want you to give them the magic number? What's that drive? Because we can all go read Howard's stuff. We know what you say. We know how you go about thinking about the world and your process. But so many people seem to kind of ignore that and go for the kind of easy layup. Hey, Howard, tell me where we are. What's going to happen tomorrow?
That's what people want. People want solutions. Most people don't want to perform the kind of serious study and rumination that we've been talking about on this podcast. They don't want the process. They want the answer. Most people understand, ironically, most people understand intellectually that the higher the market is and the longer it's gone up and the more positivity it has risen on, the less potentially profitable and the more precarious it is, and vice versa. So most people understand that there's a cycle that takes place, that where the market is in its cycle determines its future potential, and they just want me to tell them, or you to tell them, where it stands in the cycle. We can make judgments, and I can share with them my judgment about the fact that the economic news has been good, the corporate news has been good, the market performance has been great. The strong market performance tends to suggest that there'll be more of the same and tends to encourage more aggressive behavior. And as a consequence, prices get high, and maybe they become too high relative to the intrinsic value, and the non-buyers capitulate and the holders celebrate. That all these things eventually tend to take prices too high, from which they are, the word I use is precarious. Everybody knows that. They'd love somebody to tell them, is there another 6 months to go for potential profits, or is the market going to start on its decline tomorrow? And the answer is nobody can tell them that. We talked a long time ago in this podcast about the fact that cycles involving people in psychology are not regular. They're not dependable. They do not repeat in their particulars. Nobody can say that when the cycle has gone up X% or has gone up for X years, that it's going to turn down. This one has risen for about 10 years if you're in the credit market like I am, or 9.5 years if you're in the stock market. The low was reached in March of 2009 in the U.S. stock market. We know how long it's gone, but I have no idea what it's going to do tomorrow or next month or even next year. I talk about tendencies in the book. I know that from elevated prices, the tendency is more to go down than to go up. But knowing the tendency tells you nothing about what's going to happen tomorrow. So, yes, you're right. In 2008, in the crisis, people started to say, what inning are we in? And what they meant was, how much longer is the pain going to go on? I gave them my opinion then. And then more recently, they've been saying, what inning are we in? Meaning, how much more juice is there in this orange? How much longer can the market go up? And I've been telling them for some little time that we're in the 8th inning. But about a year ago, I made the key realization that the analogy to innings is really dangerous, because we know that a regular baseball game is going to go 9 innings. They never go 8, and they never go 10, and they never go 7 or 12. Regular, non-tied baseball games go 9, unless there's rain. But in the markets and in things that do not operate according to rules and regulations, in things where humans with their psychology are involved, we never know how many innings there are going to be. People should not rely on the absolute advice. But I think it's reasonable to think that when the market has gone up for a long time, and when the valuations are above average, and when a lot of optimism is incorporated in asset prices, then the tendency is more likely to be negative than positive. That's the only conclusion we can draw, but certainly not where we absolutely are, and certainly not what's going to happen in the near future.
To take a line from your work, the study of cycles is really about how to position your portfolio for the possible outcomes that lie ahead. That's just not a sexy CNBC soundbite, is it?
No, it's not. The pop culture wants people who will tell others what to do. It's really interesting that most of the people who appear on TV or in the press and who tell people what they should be doing never present the scorecard. They never say, I think you should do X. And by the way, 30 out of my last 100 pieces of advice are correct, or 60, or whatever it might be. I see these people on TV, and I kind of say to the screen, okay, how are you doing in your personal account? Are you making money? What are your returns? How dependable are your judgments? And of course, these things are not reported. When I was a kid, I once heard someone say that an economist is like a portfolio manager who never marks to market. That is to say, who never computes performance. I think a lot of the talking heads are the same.
I have one final question for you, Howard. If you're willing to share, are there, beyond, and I'm going to give you the title of your newest book here in a second, but are there any books right now that you are reading, anything that you've read recently in the last year, anything you might want to push my audience along to check out outside work beyond yours?
I have a couple of books in the works right now. I mean, on my night table. One is called Factfulness. And basically, it says that people reach conclusions about what's going on in the world based on their impressions and based on the media. And the media tends to emphasize extremeness. You never see an article which says, well, things are normal. They usually say things are too hot or too cold or too strong or too weak. The authors of Factfulness show you that things are not as extreme as the media portray or as negative as most people think. And I think that's really important. And another example of something I'm reading is Thinking in Bets. The author is one of the most successful female poker players, professional female poker players, and also a PhD in decision sciences. She talks about how to improve our decision-making process by reducing our potential decisions to bets and how to think about placing those bets. So those are two examples. Neither of them is strictly an investment or economics book. They're both interesting, educational, and also fun.
I had the second author on this podcast 3 times, Annie Duke. She is great.
Yes. Anybody who wants to make better decisions can learn from both of those books.
Howard, your book coming very soon, Mastering the Market Cycle, Getting the Odds on Your Side. Thank you for taking me down. I mean, I ask questions usually for myself, and the audience likes to listen, but thank you for taking me down the educational journey. I could probably sit around and for hours upon hours and just find little things to ask and get you to ruminate on. But hey, you've got things to do, but I appreciate you taking some time today.
Well, thanks a lot, Mike, and I hope your readers like the book. I hope it helps.
Thank you, sir.
My pleasure.
This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion.
My guest today really doesn't need an introduction for those people that have happened to walk into a bookstore in the last 10 years. Jeffrey Gitomer, author of The Little Red Book of Selling, among many books. But his Little Red Book of Selling has sold 5 million copies plus, translated into 14 languages. Now look, I've sold a couple 100,000 books. That's really good stuff. Most authors never touch that. 5 million copies that Jeff has sold on one book? You've got to be kidding me. That's like all-time stuff. That's just awesome. I'm not going to give it away either too much here in the intro, but his Little Red Book of Selling really inspired me several years back. The risks that he was clearly taking as an author outside of the envelope of typical publishing. Jeff was taking a chance to do something different, and he got rewarded for it. And damn it, if we can't learn from someone like that, we might as well retire and head on down to 6 feet under and just give up. But we are lucky, I am lucky, that I get to have these conversations with great minds. And this conversation with Jeff Gitomer is one of my favorite all-time conversations. It's easily in my top 10. Now, maybe I'm biased because I thought his book was so cool, but I don't think so. I think you're going to feel just like I feel right now, that Jeff brings a certain perspective, a certain view, a certain honesty that only comes with experience and success. Very humble, but very interesting. I hope you enjoy this conversation with Jeffrey Gitomer, because you know what? I sure did. In advance of this call, it jogged memories back for me because my first book came out in '04 and then another book in '07. Nowhere near your numbers, but for an author to sell 100,000 plus in the investment book space, okay, this is noteworthy. I started thinking about my third book, and I'm going through those bookstores, and it's like every inspiration I had was like, I don't want to do like everybody else is doing. I want to do like this guy Gittimer. That's who I want to do. I want to make a little red book of selling in the investment space. But let me tell you what happened. So it ended up becoming, your book really inspired me for my 10 Commandments book. But the thing that I really wanted to address with you and let you comment on it, let you run with it, through the publishing circles world, when I started asking about your book, the word that I got, and you'll have to correct me if I'm wrong in my understanding, is that one of the initial reasons that book had so much success was how you did it initially. My understanding is that you did everything in-house, basically had the book fully produced, and already had sold a lot of copies, and then went to a publisher for wider distribution.
I did do everything in-house. The book actually took about a year longer to produce than I thought it would, because I wanted to put everything I had into it. The publisher, Bard Press, actually came up with the idea. We were sitting in a Mexican restaurant in Austin, Texas, and he said, Harvey Pinnock put out that little red book of golf. I think you should write the little red book of selling. He sold 1.5 million copies. You'll sell more. And I started on a napkin. I started to pen out some of the chapter titles. And chapter 1 is Kick Your Own Ass. And chapter 12.5 is Resign Your Position as General Manager of the Universe. And I knew that I had to write something about networking, about asking questions, about humor. Literally, I halfway fleshed out the book at that restaurant. I came home and I started to write, and then I got diverted, and then I started to write, and then I got diverted. But I hired a designer for typesetting. And that's one of the secrets of books. Publishers can't design worth a shit. So I charged the publisher for my design guy. They can't refute it because I've won awards for design and I've sold millions of copies of books as a result of it. So they end up doing it. Even Amazon on this, the book we're going to talk about today, Truthful Living, I designed this book. They didn't. And it was it was almost a fist fight as to who was going to, do the design. I said, look, send me all the design awards you've won, and then we'll talk about it. And they didn't have any.
That's funny, though, because here you've already got the street cred of 5 million plus for the Little Red Book of Selling. And I know Amazon is new to the ballgame for being a publisher now a little bit, but why would they want to debate with you? You've kind of got a track record there.
You know what? Let me tell you something, though. They may be new to the publishing game, but they're already number one. I have never, I've been doing this for 25 years. Amazon is head and shoulders above any other publisher / printer / book distributor I've ever seen. They have their shit together, totally.
Well, that's a great tip for me that I will figure out how to execute on. Trust me.
Let me put you in touch with my agent who has that inside connection. His name is from Literary Management, and he is the brightest guy in New York City in the publishing business. And he's the one that made this connection happen. Amazon is the future, period. Well, if you wanted to republish your book of Trend Commandments, what a great title, by the way. I bought it for the frickin' title. And then I perused the book inside. They have you can go inside of it pretty decent on Google. I looked at your chapter titles, and you think like I think. So I was excited.
Listen, I'm not joking. That was literally, my publisher at the time was Pearson, Financial Times, Prentice Hall, all those names. And I was working with a guy named Jim Boyd, and I was literally having the conversation. I want to do something, I kept saying your last name, like Gittimer's done. That's what I want. And of course, I didn't know your full process, so I was only able to get some aspects of the full creativity that you get, your full design,
Well, I can tell you this. The Little Red Book of Selling is now the best-selling sales book of all time. We were on the Wall Street Journal bestseller list for 103 straight weeks. Nobody will crack that one in the sales field, even in the personal development field. It was an unbelievable process, but we invested in placement. We invested in airports. We invested in Barnes & Noble. But in those days, if your book made the list, all of the bookstores would put it face out in a special place. So it was always in the front of the store. You know, if you're number 12 on the Wall Street Journal bestseller list or number 7 on the Wall Street Journal bestseller list every freaking week, people pick the book up. And it's Michael, it still sells.
That does not surprise me at all. And, look, before we jump into your newest book here, The First Writings of Napoleon Hill, Truthful Living, I made a note to myself about the Little Red Book. I kind of jotted it down here in a highlighter. And I said to myself, who throws it away? Nobody throws that book away ever.
Nobody. Here's what happens. People lend it to somebody else and they never give it back. I get at least a dozen orders a week of somebody that says, I gave this to somebody, they never returned it. I need another copy. I
mean, look, you've been at this game for a long time. You've got a lot of experience, but you must have had in your process, your thinking, that as you were putting that together, you knew that you wanted to create not only would the textual content, the words, images, etc., resonate, and you would deliver the goods that way, but you knew you wanted to have almost a piece of art that people, all the way from the little ribbon that hangs through the page reminder. I mean, you knew you wanted all of these details, and you knew how critical that was going to be.
I'll share a secret with you. 10 years before the Little Red Book was an idea, my friend and photographer Mitchell Carney here in Charlotte gave me a book for Christmas called Paris Out of Hand, printed by Chronicle, I believe. And it looked exactly like the Little Red Book. And I said, one day I'm going to have a book like this. It had an upside down graphic of the Eiffel Tower. I mean, it was just the coolest little book on the planet. When Ray Bard said the Little Red Book, the first thing I thought of is, I know exactly what this book's going to look like. And I called Chronicle, and they wouldn't give me the resource for the printing. I mean, like, seriously. 5 minutes later, I found out where it was printed, and I called the lady back, gave her a slight expletive tirade about how sources are no longer secret. And then I gave her 2 more sources in China that I thought she could do a better job with the book next time.
Let's point something out, too, for some out there that have not seen this book. The details go to the color, multicolor. I've not held the book in my hands for multiple years, so this is all on memory. It's multiple color. It's a heavier paper. It's glossy. It's got a beveled edge, I believe. It's got a kind of a cloth cover on the front. It's just every damn detail that one would want as an author. This is when I was trying to put my third book together. When I listen to you, I say the same thing. I'm like, one day I'm going to pull off what you pulled off.
You're creative enough. You've already created the concept, the titles. You know what you're doing. I think what you need is a publisher and distribution.
Even though it's a conversation between me and you right now, your Amazon tip is probably going to be a tip that a lot of people are going to be like, Mr. Amazon, please talk to me now too.
Well, I'll give you my person, but I think it's only fair that you go through my agent because he's the one that set everything up. I can also tell you that Amazon has graciously provided me with an outside PR firm, and they're going fucking gangbusters. If you have the right book, they will back it. If you go to a standard publisher today, they have their own, quote, marketing person who's usually a journalist graduate from a recent graduate from high school who's almost like an intern, and they will do 4 or 5 things for you, and that's it. This PR firm has already done 30, including this interview with you, has already done 30 things for me, and we haven't even started because Amazon has hired them for 6 weeks after the launch. So that's October 30th literally through the end of the year.
It's funny. Usually my podcast is something where I will go find people. Occasionally I'm connected. I'm friends with Ryan Holiday, and Ryan has graciously sent me some really nice guests over the years. But you're right. Your PR person reached out to me, and I'm like, oh my gosh, I've got this whole backstory with Jeff and I get a chance to talk to him.
It helps to have a kind of a name and a kind of a reputation. I can tell you that. But what is happening right now with respect to this Napoleon Hill book is literally, it's scary to me.
I'm holding your galley right now, so this is going to be a hardcover, I assume.
Yes, it will be. But take a look inside the galley. Is the book autographed?
It is.
When is the last time you ever got a galley copy from a publisher?
You know the answer.
Right. It's a 2-word answer. Fucking never. And the reason that I did it is that I'm sick of getting galley copies and hard copies from PR firms or from publishers, and no one even signs their name to the letter. It's crazy. So I demanded at Amazon that they let me sign all the galley copies. They printed about 1,000 of them. When I'm dead, you might want to go on eBay and get your money out of this one.
As people are listening to you right now, though, on something simple sounding like signing a galley copy, and people that don't know about galleys, these are the pre-release copies sent to people like me. You're giving a lesson in sales right now, a very important one.
It's called personalization, so that the person feels connected before they even start to read. It becomes wow when they open up the page and they see that the author signed it, and then someone else has to read it slightly more voraciously.
I admit, I was very surprised. I've never seen it before. You've not sent me any kind of wire payment. I've never seen a galley signed before, ever.
The next one you see signed will be my next book with Amazon.
Oh, and by the way, too, the galley that they sent me is basically essentially the same quality that you would see in most paperback editions or nicer of a finished book.
Right. I refused to let them do it crappy. I hounded them to make sure that at least the galley copy would be something that someone would not throw away. And by signing it, it's definitely not been thrown away. And I'll tell you, I've had 12 people proactively send me email for the galley copy thanking me.
Well, I got to tell you something really funny too. My girlfriend saw it, and she started looking through a bunch of books that I had, and she said, "Well, can I have this one?" And I said, "Okay, you can have it." That was before I read it, and then when I started reading it, I saw the signature inside. I'm thinking to myself, "Oh man, I really don't want to give it to her now."
Exactly.
We should shift into there because I could keep picking your mind about everything. And this is a really cool book. And the content is timeless, as you know. Let's set the stage here. I don't know if you saw the movie, but recently a movie came out called The Founder about Ray Kroc. And in that movie, he's listening to some old motivational tapes. This is set in the 40s and 50s. I don't think it's Napoleon Hill. I think it's somebody else. But it's the same kind of headspace. For me, for my audience, give the mini bio on Napoleon Hill. When did you first come into contact with the name and his thinkings?
In 1972, if anyone alive can remember back that far, my twin daughters were just born. I was in a marriage that was not going to last. I was pretty much broke, and I had no direction. I joined a troupe of guys who were in, at that time, multi-level marketing. And the leader of that troupe was Glenn Turner in a company called Dare to Be Great. 5 guys, me and 4 other guys, met every morning in a sales meeting for 4 hours, from 8 until noon, every day for 1 year. In that meeting, we watched a movie called Challenge to America by Glenn Turner. We listened to The Strangest Secret by Earl Nightingale, and we did a book report on 1 chapter of Think and Grow Rich every day. Now, there's only 15 chapters in the book, so we would go through the book every month. And I literally read from cover to cover that book 10 times in 1 year. And after about the 3rd reading, I got a positive attitude. I can't explain what happened, but I can tell you exactly where I was at the time that I realized, oh, I got it. And I was in New Jersey. People in New Jersey, positive attitude, I think, is a jailable offense. You can't take it away from me now. And it's because of Napoleon Hill. He was the founding father in America of positive thinking and personal development, not just how you have to think positive and be positive, but what are all the elements in going into being a success? And this guy and this book, in 1917 at the George Washington Institute in Chicago, he had a course on advertising and selling. But at the end of every lesson, he wrote his philosophy for succeeding and how and why, and positive thinking and ambition and desire and all of the elements that go into it. After he passed away, the Napoleon Hill Foundation found these works 20 years before Think and Grow Rich came out. Now, Think and Grow Rich has sold 100 million copies. It's the benchmark book of, the magnum opus of Napoleon Hill. But this writing from 1917 is the foundation of that. I'm reading this stuff. The Napoleon Hill Foundation, just a slight backstory, as a gratitude for my positive attitude, I was introduced to the Napoleon Hill Foundation by Charlie Tremendous Jones, who was my mentor in speaking. I volunteered to do the newsletter for the Napoleon Hill Foundation, Napoleon Hill Yesterday and Today. I've been publishing that for more than 10 years, gratis, just as a thank you. Every Friday, it goes out to about 50 or 60,000 people. They came to me and said, hey, we found this stuff. Do you want to write or annotate, Hill's original writings? I'm like, hell yes, I do. That took 2 years. Like, I went through every lesson, everything. I took away all of the sales part of it, and I just left the what's called after the lesson visits with Napoleon Hill. And I'm going to tell you, Michael, it's absolutely unbelievable. My girlfriend was the editor, and as she's editing, she's texting me going, have you seen this one? Have you seen this quote? And she's like texting me quotes from the book. It's very inspirational.
Let me read one really quick. I'm going to try and read it quickly, but it's a great one. It says, you may be wealthy for all I know. That isn't success. You may have a splendid education for all I know, but that isn't success either. You may have wealthy parents, but neither is that success. For you must remember that wealth, as measured in dollars and cents, is an evasive thing, which sometimes takes wings and flies away. The only real, permanent, and worthwhile success is represented by the character you are building. And you know what? When you read that, you can't help but feel energized.
Exactly. There are 100 of those quotes in this book, plus all the information. As you peruse the book, you see the little maroon full-page quotes. We had to limit them. I had to literally go through and select those quotes that I thought would be most appropriate. I also have to tell you that I just finished recording the book. And because I didn't write it, and because it was written 100 years ago where lexicon was different, it literally took me 15 hours to record a book that would have normally taken me 5.
I had never practiced what I just read right there, and I agree with you. The lexicon is different. And as you read it, you have to kind of quickly do the mental gymnastics to get around it.
Let me throw something just from the very beginning of the book, as long as you're reading a quote. He says, believe in what you are doing and in those who are helping you do it, and you are bound to win. In that quote, he's saying, hey, gather a bunch of people around that support you, believe in yourself, and now you have a team of people instead of just one person going for it. It guy's freaking brilliant. And this is before the cars had paved roads. There was no airplanes. There was no anything. No TV, no computer, no nothing. You had a checking account. If you wanted to go someplace, you took a train. And he's sitting there espousing what's going to happen 100 years from now, literally. And he was right. He predicted Amazon and Walmart.
What's so nice about his work is in a world right now where people are, kind of got attention deficit disorder. They're jumping around to this headline and that headline. And what I love about the work that you've put together here is the breaking it down to the bare essence of thinking. And what I love also too, and this is from Napoleon Hill, this is his classic opener, thoughts are things. And that's very difficult, in my humble opinion, that's very difficult for initially at least 95% of the population, whatever population, to accept thoughts are things.
The thoughts are things quote doesn't come until almost 2/3 through the book. And when I saw it, my blood ran cold. Like, okay, here's the beginning of the process. And he's telling me, literally as a reader of his early writings, oh, I found it myself. I'm going to use this from now on forever. It's pretty cool. I mean, this book is historical as much as it is challenging and inspirational. It lays it out. It tells you exactly what to do. He does it in a way where he doesn't say, you're a jackass if you don't do this. He's just saying, hey, this is what I do. He's one of his quotes at the very early part of the book is finish what you start. He clarifies it by saying, the time has come for you to succeed, but you cannot do it without finishing what you start. Like, dude, way to go. I think that there's a deep thinking behind this. This guy had to go home at night and marvel at the electric light, by the way, when he turned it on. That's one of his things. He goes, wow, Thomas Edison invented this thing. Look, I can just flip the switch and the light comes on. We don't think about that today. We have LED lights that come from China that you turn them on and they're way better than any light has ever been before. But the bottom, and they don't get hot and whatever the deal is, but it was a marvel back then. The phone was a marvel back then. The automobile was a marvel back then. The typewriter was a marvel back then. Think about all of the elements that went into early part of our own industrial revolution. You know, the cash register was a big deal. Hill did this all in what we would refer to as primitive times, literally primitive times. Can you imagine a guy with no cell phone?
When I read a sentence of his, and this is going across the work that you've put together here, there's no excuses. You read the sentence, and it's almost like you've now got horse blinders on. If you jump off the sentence, you're making excuses. Like, the sentences are so pure. If you leave it, you yourself know that you're doing the wrong thing.
Very compelling. And I'll tell you, I got a much deeper understanding, having edited the book and gone through the process, at least 10 reads of it before I ever turned it in, and annotated it and put my own, writings in there. But I didn't touch his. I left his words pure. But reading the book out loud, like I just did this past week, it's a whole new insight. I have a digital studio. I'm very fortunate. We have a really solid crew of people because we're podcasting now 5 days a week, and I record all kinds of all my YouTube videos. Everything's done in studio. My producer was going, wow, that's really cool. And I was stopping going, do you realize what he just said? So the edits are boundless in this piece. It was uber inspirational to do it. And it's made me a much bigger expert on the book, I can tell you that.
Let me keep it at something that I just brought up a moment ago, where the notion of thoughts are things. I'll really elaborate and kind of tear that apart, peel back the onion some. But also, there's a sentence that I jotted down from the book: 95% of those out there, and this is not meant to be some kind of ad hominem or something negative about people, but 95% of people really don't know how to think. It is an acquired skill.
What he says in Thoughts Are Things, he's saying that everything that was ever invented and everything that you look at every day began as a thought before it ever materialized. He's telling the reader that if you're not thinking of something new, you're never going to do anything new. You don't just wake up and say, okay, I'm going to do something cool. No, it started in your mind and manifests itself. Maybe you thought about it, then you sort of jotted it down, and then a week later you came back and edited, but you're still thinking. Your mind is still going through that thought process. Every one of your listeners right now, you've been in the shower or you've just gone for a run, and all of a sudden a thought pops in your mind. Mostly because your mind was clear, but that thought will vanish if you don't write it down immediately. And it is the beginning. It's that the seed of whatever it is that you're trying to plant. By writing it down, you're starting to water it. You've planted it, you've started to water it. But it began as a thought. And when he says thoughts are things, he's saying all of these things began as a thought. Then someone did something about it, and it manifests itself as a light bulb or an automobile or a telephone or an airplane. That's the process. The Wright brothers thought about flying in Dayton, Ohio, but didn't take off until they got the Kitty Hawk. That's what he's saying there. And it's so freaking deep and so freaking brilliant that you pass it by.
It's 3 words, and you're right, it's so deep, but it's 3 words.
What he says all along in the book is everything that you touch or do or feel or wear started as a thought. That's the process by which he is sticking to as an underlying theme throughout the entire book. Think about it. Think about it.
Those three critical words, what they do in my mind is they transmit to the individual, you have power. It's now on you. Your thoughts are things. You as the individual have immense power, but you probably just don't yet know it.
That is totally correct. And most people overlook their own power because they're too busy watching television like a fool. But let me throw something at you. He talks about these elements, these 5 basic elements of enthusiasm, self-confidence, concentration, and imagination and desire. And what he's saying, all of that is thought. All of it is thought. Think about imagination, desire, enthusiasm, self-confidence, and concentration. They're all thought. He's telling you, dude, get into your own head. You're going to start to succeed. Until you do, you're working for somebody else, getting to work on time at 9 o'clock in the morning, and you're going to do jack shit.
You know, I love this podcast, Jeff, because there's nowhere else that I know of that I could have turned on any TV show in the United States of America in the last year to hear what you're saying.
Thanks. Thank you very much, Michael.
I mean, I'm serious. I mean, that can sound flattering, but I'm saying it as an objective fact too. Because if I turn on any news show, if I turn on something else, it's all about everything else that's not important.
Blame and bullshit. Those are the two things that you get when you turn on the television and you're watching any kind of something that someone else considers factual. It's somebody else's opinion of what happened.
Well, what's great too is about your work, and we're such in a divided world these days. There's these different tribal factions. There's nothing tribal about the works of Napoleon Hill. If somebody can find something tribal in here, I think they need to go see a doctor for some type of a mind checkup.
He doesn't care who you are. He doesn't even care if you're a criminal. He's telling you that if you change the way you think about yourself and you focus on what's important to you as a person, you can turn any failure into a success. And you can take your failures and turn them into lessons. That's the main thing. That, you know, people get all upset and they start slamming doors. Like, dude, sit down, write what happened, figure out what you need to do so that it doesn't happen again, and then do that. And he does it in such a compelling way that you can't help but want to try it. And that's the whole deal. Once you start to play with Napoleon Hill's words and you start to put them into your own life, it changes everything. You know, 1972, think about that. That's a long time ago. My twins are 46 years old, so I know exactly what it is. If you can carry around a positive attitude for 46 years, you begin to develop it. Yeah, I also wrote the Little Gold Book of Yes Attitude based on the fact that I wanted to put my own attitudinal thoughts into writing. And that book, it's 10 years old. I just came out with a new edition after the 10th. It's sold more than 300,000 copies in America. It'll sell 1 million copies. There's no doubt in my mind. You know, Amazon will pair it with the Napoleon Hill book, and all of a sudden it'll make a bestseller list someplace. Totally crazy what Amazon can do.
Let me go back in time a little bit here, because as people hear some of the sales numbers, they're probably thinking, well, my gosh, you know, Jeff must have the literary pedigree. He came from the finest schools, the best grades, and all that kind of stuff, right? That's exactly true, right?
I'm a product of my parents who were intelligent. So I was born with the gift of intelligence, and then I had to decide what I was going to do with it. Well, I sort of pissed it away at school. I went to Temple University in Philadelphia, Pennsylvania. I could have dropped out of any school, but I chose to drop out of Temple. And I traveled in Europe for 1 year at the age of 20. When I landed on the plane, I realized that I knew everything. You know, I'm just going to go around and I'll be Mr. King Shit. When I actually got out of the plane and walked around some of the cities, I didn't know anything. I mean, I had no concept of history. I had no concept of what happened on the continent in the Second World War. Went to a concentration camp museum at Dachau, read the diary of Anne Frank on her doorstep, studied everybody that I possibly could from Vienna to Stockholm, and I got an idea of what I had to do. I had to learn something new every day. And you can't learn something unless you admit that you don't know it.
Did you go solo to Europe?
Yeah, I went by myself.
How important was the by yourself part of it?
It was all important. You don't go with when you're going to make a trip like that, that's your life's journey. From that trip, I got wanderlust. I was staying at a hotel in Paris, and the lady was a lovely, nice Jewish lady who took a liking to me and said, look, you can keep your bags here and take a train any place and then come back here and your bags will still be here. I'm like, cool. And so I used Paris as a sort of a jumping off point to travel around the continent. And I went everywhere. I mean, literally, I went to every major city on the continent, ended up falling in love with a girl in Berlin, ended up skiing in Switzerland for a while. I mean, it was all kinds of things happened. I got hit by a car in Copenhagen, and the guy that hit me took me to the hospital. All kinds of stuff happened. And by the way, they don't call it Danish pastry in Copenhagen because you're already in Denmark. They just call it pastry. The challenge that you have when you're on a trip like that is you wake up every morning and it's a new adventure. I'd never been to any of these places before. So every time I got to turn a brand new corner and you meet somebody on the train. I took a German course in Berlin to learn how to speak German. One of the kids in my class, and this is 50 years ago, follows me on Instagram. Now think about that. It's mind-boggling.
Let me share something with you really quick. I don't recall his name off the top of my head. The founder of Fiji Water came from a wealthy family. His father told him, same kind of age, early 20s, he said, look, I'm going to give you a choice. I'll give you some money to start a business, or I'll give you money to travel the world. However, if you choose the money to travel the world, and I find out that you travel with anyone, the deal's off and you get nothing.
Oh, yeah, that's great. I think it's more difficult for a woman to travel alone these days, but not impossible. If you understand the rules, I have a 9-year-old daughter, even though I shouldn't, I do. I have a 9-year-old daughter. She's been to Paris 8 or 9 times. I've lost count. She will know how to travel by herself safely because I'm letting her now take little walks and, go places that she wouldn't dare. I have all of my granddaughters are older than my youngest daughter. So this summer we took my 16-year-old granddaughter and they went out together for walks. They did it. When you're 9 and you can be semi alone in Paris without a parent, you're going to be okay. Knowing how to take the elevator, or knowing how to take the escalator, or knowing where you live and knowing the code for the front door, or how to use your metro ticket. That's the deal.
One of the ones that I want to let you elaborate on, I feel very attached to this. I run my life this way in many ways. Of course, I'm a capitalist. I like to make money. I like to have some success. I've got a little bit of ambition, all that kind of fun stuff. But the principle of service is ultimately the foundation of where I have found any success, because ultimately there's been so many people ahead of me that have given back to me, and I've kind of given back to them. And so I've just found that this notion, and Napoleon Hill probably outlines it better than my own thoughts, of course, but the principle of service, so key, isn't it?
It's totally key. There's a 5,000-year-old ancient Chinese proverb that says, to serve is to rule. And you bring it into the 21st century and you see all the companies that serve the best end up winning. You can say anything you want about Amazon, but their service rules. You can say anything you want about Nordstrom or Southwest Airlines, their service rules. They live by their service philosophy. I have taken that. I've taken it in a slightly different direction, Michael. Part of my philosophy is I give value first, which basically is a service principle. I'm looking to do something for the other person and something in a way that becomes memorable and they are either grateful for it or whether they acknowledge it or not. I didn't do it for them. I did it for me. I perform one random act of kindness every day, no matter what. And I do that. The other person feels good, but I feel way better. People don't realize that service comes from your heart, not from your head. You don't have, not like an obligation to do it, although we have a kind of a disdain for it in this country. But when you serve, it comes from your heart, and that's the principle. What Hill is saying is you feel great when you serve other people. And literally it leads you to success, because even though that person may not pay you back, the world will pay you back because you are servant. That's the principle that you have to live by.
It does. It just makes you feel good, doesn't it?
Oh, hell yeah. Hell yeah. Even if it's just holding a door for an older person, or helping somebody up if they've fallen down, just something that makes you feel okay. It's amazing what it does. And I'm on a mission to do one a day, no matter what. Sometimes it's leaving a bigger tip. Sometimes it's opening up a car door. Whatever it is, it makes you feel good.
I don't recall ever, because I got the Little Red Book of Selling. That was the first book of yours that I've ever seen. I don't recall ever going, once I had the book, I didn't need a review. I made my own judgment and didn't really care what anyone said. I'm curious, though, for a guy like yourself who's so prolific, multiple books, millions of sales, and I'm sure if I went to Amazon, I guess I could find criticism there. I've never read it, so I don't know what people say. But I'm curious your general view on criticism as a whole. What do you even think of when you think of the word criticism? Is it even something that you even ponder at all? Or
I'll throw this at you. When the Eiffel Tower was built in the early 1900s, 300 prominent French people, the leaders of the country, wanted it torn down the day after the exposition was over, because they called it the ugliest building on the planet, the ugliest edifice on the planet. They didn't tear it down. People were still angry about it. Guy de Maupassant, who was one of the biggest critics, ate lunch at the Eiffel Tower every day for the rest of his life, because it was the only place that he could be in Paris and not see the Eiffel Tower. But in 1600, some Finland guy said, no statue was ever erected to a critic, but the people that they've criticized, many statues have gone up. And if you go to the Eiffel Tower, you'll see a statue of Gustav Eiffel that's absolutely gorgeous, but you will not see a statue of any of his critics. Think about it that way. Same with the guy that built the Brooklyn Bridge. Same, if you look at anybody, they'll criticize Elon Musk, or they'll criticize Jeff Bezos or Steve Jobs. Dude, those are the founding fathers of their respective business. They're going to march forward. They don't give a shit what anybody says about them. They get to wake up, and if somebody criticizes me, this is my philosophy about it. I get to wake up in the morning and be me. They have to wake up in the morning and be them. And I'm happy with who I am.
I'm looking at one of my notes here as you're talking, and I'm feeling it. And what I'm feeling inside this Napoleon Hill book that you've put together, ambition is a contagious thing. I'm already an ambitious guy, but I can literally feel you across the lines, and I can feel more ambition, and it feels contagious to me.
Attitude, enthusiasm, any kind of passion is contagious. You get it from the other person if you feel it from them. We will be inspired all day long based on this interview, maybe all week long.
I won't be able to sleep early, that's for sure. Hey, listen, you've got about a little over 20 years on me around, but I'm curious, for people that are listening right now, you've got more energy in your voice than most lethargic folks that I meet in their 20s. And look, there's plenty of folks in their 20s in Silicon Valley that are tearing it up. So I don't want to generalize there. But what have you done differently? What have you learned about the aging process and attitude that's different? Why are you not slowing down at all?
There's a real easy sentence that I can give you. I love what I do. And if you love what you do, if you're passionate about what you do, then every day is a great day. I don't have 2 days alike. I don't have 2 speeches alike. I don't have 2 books alike. The challenge that I have for myself is I don't have enough time in the day. I think sleeping is the biggest waste of time of my life. So I try to do it. And people say, well, you got to have 8 hours. I got to have 6 hours. I don't even want those if I can help it. But the challenge that I have is I have a passion for what I do, and I have an idea for what is next. What is next is the most important thing in life. Because if you live in the past or you dwell in the past, you're never going to get to the present or the future. You can learn from the past, but you can't live there. So I live in the moment, but I'm ready for tomorrow. And I'm ready in a way that my ideas are there and my philosophy is there and my strategies are there and my connections are there. Just look at the friendship we built in an hour.
You meet people, and I'm sure you could say the same thing back to me, older people than you that you met along your career, and we all become older at some point in time. I mean, my gosh, I don't know how I got to be my age. It just happened like that. But, I just want to be inspired. Every person in my life, I just want to be inspired. And look, I'm old enough now to where I enjoy, if I can give inspiration to somebody who is hungry for it too, I will. Look, there's a friend of mine, and she's Vietnamese, and she has found a way to get herself down to grad school in Australia. And I was texting with her, listening to some of her story. And I actually sent her a few screenshots from this book. And she was just so excited to get the positive feedback. It was just, and so I love that kind of stuff, just like you do.
I will tell you that more than 20 years ago, I was at a networking event in Charlotte. I'm a huge wrestling fan, professional wrestling, the guys that sort of fake it.
Don't tell me you know Ric Flair.
I do know Ric Flair.
I hate you.
But somebody came up to me and said, "Hey, I know you're a wrestling fan. Nikita Koloff, the Russian Nightmare, is here. Would you like to meet him?" And I go, "Sure." And Nikita was a bad guy. He comes up and he's this, big hunk of a guy. Jeffrey Gitterman, he shakes my hand. He goes, "Oh, it's nice to meet you." And I looked at him. I said, "I've hated your fucking guts for 10 years. He goes, "Well, I guess I was doing my job." We actually became friends, so friendly that he's now my house guest at least once a month for about a week because he lives out west and he travels back east. He stays with us. He's like my brother. I'm honored to have him as a friend because now he's a minister. He saved all his money. He's, financially independent, and he goes around and preaches and helps other people. One of the key principles of our life together as friends is our passage from the Bible that we both discovered from one another. I asked him one day, I said, "What's your favorite passage?" And he goes, "Well, it's from Matthew. It's O ye of little faith." And I took my Bible out and I showed it to him that I had it underlined. Those kind of things. And think about it, because Napoleon Hill writes about faith. I talk about how you believe in yourself. But, it was the boat ride where Jesus calmed the waters. It's just a phenomenal understanding of, dude, if you don't believe, you're going no place, whether it's religion or business or the business of religion. But the bottom line is I developed a friendship with somebody because we felt we had a common bond. And then all of a sudden, literally 20 years later, we figured it out.
If we took the Little Red Book of Selling and did a separate hour-long episode of literally connecting the Little Red Book of Selling to professional wrestling and how they get so much of it right, my gosh, how much color could we add there for the last 30 years, huh?
Nikita and I wrote a book called Wrestling with Success. And he talks about his year-long battle with Ric Flair. I think he wrestled Ric Flair about 400 times in 1 year. But, the outcomes are predetermined. It's not fixed. The outcomes are predetermined. Those guys are ready. They are prepared. They are absolute specimens with 8% fat. It's unbelievable who they are and what they're capable of doing in a rink. And a lot of the guys have been to my home. A lot of the wrestlers, they're great guys. They're fun guys. I've just been really blessed in that I got to sort of meet my heroes. Because I used to take all my kids to the wrestling matches. It was funny as hell.
I remember watching probably in the late 70s, early 80s was when I first started watching. It was mostly Vince McMahon's stuff back then. So I didn't really come into contact with Flair until later on. But some of those old YouTube clips where you can go find Flair, where he's on fire, you find him on fire and you just say, my gosh, this is the most amazing performer. To watch him talk to the announcer, you can't stop watching.
Exactly. He was as prolific as anybody in terms of patter. He knew what to say and he knew how to say it. If you ever really watch deeply, Dusty Rhodes, the guy who was called the American Dream, he was the brains behind all of those storylines. like who would beat up who and how that would evolve and who would get to the championship matches. And then Vince McMahon started his own thing.
Dusty had one of the worst wrestling bodies ever. He was really just...
Oh, yeah. I want to end with something, because the listeners to you are looking for something that they can take away and they can take back to their office or they can take back to their home and potentially turn it into money. In the book, literally it's on page 206, there's a quote. It begins with the chapter, The 5-Point Rule. Napoleon Hill says, "Success may be had by those who are willing to pay the price. And the price is eternal vigilance in the development of self-confidence, enthusiasm, working with a chief aim, performing more service than you are paid for, and concentration. With these qualities well developed, you will be sure to succeed." Now think about that. This is written 100 years ago, and there's not one word in there that has timed out. It'll be valid 100 years from now.
Not only are they not timed out, but every word is needed, and there's not any extra that's not needed.
Exactly. There's no adverbs or adjectives in there that you can say, well, you could edit this out. I didn't want to edit anything in this book. I wanted people to see Napoleon Hill's real words. I took away some of parts of the lessons, but I did not edit one word of his in personal development or in positive attitude or even in selling. There was no reason for me to do it. I'm not, who the hell am I to take away somebody's word? Either fortunately or unfortunately, it was written in the mail, because in 1917, women were housewives, or, they weren't in the working world the same way they are right now. So you have to interpret some of the things as men or women. But the bottom line is, this stuff is unbelievable. I would implore anybody just to go out and read the book twice. You can't read it once. Read the book twice, and it's life-changing.
I want to give a reason why I think people should check it out. Something that I love to do with Google is a lot of the out-of-print books, and I've gone back 100, 200, 300 years to look for investment books, right? And you've got in the rear of this, in the appendix, it says books you ought to read. These are Hill's original recommended readings from 1919. I'm not going to name them, but I haven't done this yet, but I have a sneaky suspicion that I can go on to Google's ancient books and probably find these. That alone, to go down the dusty trail of figuring out Hill's influences, is a really cool exercise.
Yeah, many of the books are available, many are not. I have them all, and I'm going to be taking my library and letting people subscribe to my library. I'm going to scan everything and put it into Kindle type of documentation. And for $10 a month, you can come into my library and peruse anything you want. You can't download it. You'll be able to read it, but you'll be able to make notes in it, and you'll be able to talk to other people about it. But all of these books will at some point be in my library that people can go in and become a member.
The book, The First Writings of Napoleon Hill, Truthful Living. What a great title, right? I should ask you before I let you go. I got to keep you for an extra minute. What does truthful living mean to you exactly?
What it means is that you are true to yourself, and that you honor yourself as a person, and that you go through your life waking up in the morning going, okay, I did it yesterday, I can do it today, and I'm going to do it tomorrow. You're telling yourself the truth so you can tell others the truth. It's how to live your life. It's not just how to make a sale, or, it's how to be a better dad. It's how to be a better person. I have always stated that you can't be a great dad for other people until you're a great person for yourself. Then you have the opportunity to be a great dad. But life is not a sacrifice. Life is continual learning, and then you help, not sacrifice, or you serve, not sacrifice. That's the essence behind the title.
Jeffrey, I hope I can convince you to come on and chat with me as future books arrive in the next 30 to 40 years of your existence. I thoroughly enjoyed chatting with you. You bring the power, you bring the energy, you wake me up. I'm going to go run around the block now or something.
Cool. What the hell time is it where you are?
It's only 8 o'clock. It's not bad.
Oh, it's not too bad.
No, it's not too bad. Where can we send people? Where's the best website? I know where it is, but where's the best place we can send people?
Amazon, for my book, for Truthful Living, go to Gitomer.com, Gitomer.com for anything else. Website's pretty complete now, and it's responsive. You can get it on your phone, you can get it on your tablet, you can get it on your laptop. There's a wealth of material there. When you buy Truthful Living, there's going to be an awful lot of other stuff about it. There'll be a Facebook group. There'll be all kinds of things. After the book launches, there'll be places where you can go and discuss it, because it will be discussable. I can promise you that. The Napoleon Hill Foundation has authorized and endorsed the book. I think there's a YouTube video up right now by Don Green endorsing the book. I'll be at the Frankfurt Book Fair in Frankfurt, Germany, talking about getting it done in other languages. I want this book in 40 languages in 1 year, and I'm going to make it happen.
I'm not betting against you.
No. It'll be in Vietnamese, by the way.
I've seen many of the motivational titles here. The biggest names I've seen have been probably Kiyosaki and Anthony Robbins. There's a ravenous appetite for these types of work, for sure.
As we were just talking about Nikita, he sends out a daily inspirational quote. For some reason today, it just came across my screen as we're ending. It says, "The secret to personal change is to know and face the truth." It can't be more realistic than that. I'm a full believer in, if you tell the truth, you don't have to remember what you said, because it will always come out exactly the same way again. It's very difficult in today's world to understand that that's the basis of communication. Because if you tell one mistruth, no one trusts you again, ever. Look at any politician. They're untrustworthy people, because they're all about self-aggrandizement and blame.
They're not needed for our personal success, our personal happiness. They're not relevant.
Exactly. Other than how much of our tax money we can keep.
That becomes an issue, but I don't know if we've got really much of a say in that really either. So.
No, but hey, it's a pleasure meeting you, pleasure getting to know you, and I certainly wish you every success in your endeavors. I will read, even though I'm not a trader, I will read Trend Commandments, because the title is freaking compelling.
Thank you, sir. I really like your ideas about working with Amazon. For a fellow author, that's very inspirational and very insightful, to say the least.
Cool. I'll hook you up with and you can sort of take it from there.
Jeffrey, thank you for your time today.
Michael, it's a total pleasure. My people will call your people again, and we'll play again.
Thank you, sir.
My pleasure. Take care, Michael.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.